a volatile session, Kevin, but in general, what do you think right now of the market where it's at?
I think it's very interesting to remain in equities, actually. Inversion doesn't really scare me because we have such a perverse situation going on in Europe pushing down these yields. But I look at cash flow in the U.S., primarily private companies, or I have some pretty strong mandates that I get to look at data that's proprietary. I've never seen a stronger economy domestically right now. So it just tells me, do I want to take the risk of getting into up the balance sheet on converts or in debt when I can get 2.6% yield on equities and have some growth potential? We're still in that zone. We're still there. It hasn't changed.
Margie, a lot of focus, for good reason perhaps, on the levels of Treasury yields, of bond yields globally, and also, of course, on the shape of the curve. But on the other hand, credit markets have remained relatively firm. They've not necessarily been showing a lot of signals that they're sniffing out some weakness. And stocks for now are in about a 5% pullback from a record high. Where does that bring you as you look across the asset classes? Where do you think folks should be best positioned?
Well, I still think equities will be the star performer over the next, say, 12 months. The best part of the bond market is the high yield market, but there I think you're looking at mid-single digit, 4, 5, 6, 7%. I think equities will match that and do better. So I think equities will still be where we want to be.
And then implicit in that is that you don't think that there is a imminent recession or that earnings are about to fall apart, correct? Because in that case, the bond market would have it correct right here.
That's right. It looks as if right now the real-time indicators suggest we're clocking along at a 2% growth rate. Employment gains continue. Consumers in great shape. That's a very strong backdrop. The Fed has taken its foot off the brake. So that says to me there's no way we're going to have a recession this year or next year.
So, Kevin, if this is a strong economy here in the U.S., the consumer is in great shape, then where would you be focusing your investments right now? Is it those more consumer-focused companies or elsewhere?
I actually am going to take a little of a contrarian view and dip back into small and mid-cap that don't have any exposure to China, that sell domestically only, that have really been beaten up. I mean, the Russell 2000, there's some sectors of it. You probably want to stay out of the safety zone like REITs. There's a lot of REITs in there. So the Russell 2000 without REITs looks really interesting to me because a lot of those companies don't talk about China, don't worry about, trade war, and they're servicing an economy that's really, really strong. And it has not performed. That means maybe in the quarters ahead I'll get a better bang for my buck in the small caps.
All right, let's talk about what the street is actually seeing about the outlook. Strategists issuing warnings about elevated recession risks and market dangers. Morgan Stanley saying the, quote, risk of nonlinear tightening in financial conditions triggering a global recession is high and rising. UBS is moving to an underweight on equities. And RBC says risk of a growth scare taking hold of the U.S. equity market is rising rapidly. Meanwhile, Bank of America says revision trends are moderate across the board and sees risks of more cuts. Goldman Sachs seeing a bigger hit to U.S. GDP from the China trade war. The one bright spot, though, J.P. Morgan says it is nearing time to add risk back and that the market will advance into year end. So, Margie, obviously a lot of this is strategists kind of observing what the markets have been suggesting and how they're positioned and maybe extrapolating the implications of that. So where would you fall on that spectrum? I gather you say stocks are going to outperform for the next 12 months. Is that because you think that the street essentially is looking at the wrong things?
Yes, I think they're looking backward in the history books at previous cycles. The Fed was too tight last year. They've stopped being so tight. And I think that in 6 months, 12 months from now, you'll see the economy actually start to reaccelerate. And so I think that will be the leading indicator that we're going to have a better equity market. There's no way we're going to have a recession with the kind of strength we have in the economy right now.